Hello, welcome to Financial Insider Weekly. I'm your host, Michael Gray, CPA. My guest today is Scott Hazlett. Scott is a California attorney and a CPA who practices in the areas of taxation, real estate planning, financial problem resolutions, and 1031 exchanges. He is a certified specialist in taxation law by the California State Bar Board of Legal Specialization, and he's also a qualified intermediary for tax-deferred exchanges. Scott previously worked with Price Waterhouse and was an investment executive with Merrill Lynch. He graduated from Taft University School of Law in 1996 and set up his own law firm. He is currently the president of the East Bay chapter of the California Society of Certified Public Accountants. And in a past life, Scott was a sports writer covering Major League Baseball, National Football League, and other sports. So Scott, welcome, and thank you for being a guest today.
Thank you. Thank you for having me.
Okay, so today Scott and I are going to be talking about sale of a principal residence. Now this is actually a fairly complicated area of the tax law, so we want you to view this as like an introduction to this area, and I hope it'll be a continuing conversation that you'll have with your own tax advisor. So with that, let's get into our questions.
Great.
Okay, so let's say I sell my principal residence, that's the place where I live, and replace it with another one. Does that defer the gain?
Boy, yeah, I'll tell you.
Did you ever hear that question?
Only a million times, you know, only a million times. But you know, I started in this business in the early 80s, you know, when I got out of college and so forth. And, you know, sometimes I like to think I've forgotten more than I'll ever know,
yes.
or you know, whatever. But for the longest time in early in my career, we had this rule about the residence rollover rule. The old 1034 was the code section where you continually bought up and bought up and bought up and bought up.
Right.
So then in 97, I think we all collectively fell off our chair when the Congress passed a rule put into place that says now we have a permanent exclusion of gain from sale of property, and you do not need to buy another property. And in fact, you cannot buy another property to get any kind of benefit like you could in the old days. So the old rollover rule was thrown away. Right. But yet today, still, this over 13 years later, or about 13 years later, I still get this thing where even if they know about the current rule about the exclusion, I still get this, well, any excess exclusion, I'll just buy a bigger house and everything will be okay. And the answer is, of course not. It will not be okay.
Yeah. So, well, you all know you get your tax advice from your barber or from your beautician.
Taxi drivers are good.
Oh, yes.
Yeah.
So
you know, so it's your gardener probably can figure it out as well.
Okay. Now, there is a little play related to this of maybe converting a residence to an investment property. Would you like to talk about that for a moment?
Well, yeah. Let's talk about the basic rule, and then we'll talk about the little play, because some of the people perhaps in the coverage area of the program are going to have a.
Okay, so let's start with the basic guidelines.
So, yeah. So let's say you bought a property in 2000 and you paid I don't know, $600,000 for it. And even despite the problems we've had in the recent real estate cycle, the property today sells for $800,000 after you pay your commission. So you have a $200,000 gain, and you're a married couple filing jointly, and you've lived in the house 2 years out of the last 5 ending on date of sale. So let's say you sold today, you closed the escrow today. So we go back 5 years and you say, have we lived in the property for 2 years out of those 5? Certainly, yes. Have we owned it 2 out of the last 5? Yes, we have. So therefore, as a married couple filing jointly, we have up to $500,000 that we can exclude. So that $200,000 is completely excluded from taxable gain. Okay, so that's sort of that's a basic example. Now let's talk about the person who bought a bungalow, you know, a 5,000 square foot bungalow in Saratoga in 1962.
Right.
So let's say the property was worth $50,000 at that time, which was an outrage,
yes.
Okay, in '62. And now, of course, it's worth $1.5 million or $2 million. By adopting the same rule, married filing jointly, they do get the $500,000 exclusion, But because we don't have a rollover anymore, let's say that they have $1 million gain on that property. Well, the first $500,000 is excluded, but the other $500,000 is a taxable event. It's a long-term capital gain taxed as if they sold stock or that kind of thing. Now, the play that you talked about, which is really an advanced planning technique that should be orchestrated by a competent tax advisor, is in the rule, it says that if a property is owned 2 of the last 5 years and occupied 2 of the last 5 years.
Right.
That does not say that you have to occupy it on the date of sale. That means that you've got this window. Conceptually, you could vacate the property, convert the property to rental property, rental use, for say, and this is a ballpark figure, this is not a statute, to say 2 years in advance. So let's say I converted my property 2 years ago and I sell today, June 15th. Well, I've qualified. I lived in it 2 out of 5 years, some time ago. I owned it 2 out of 5 years. And I get my $500,000 exclusion, which is wonderful. And now the excess is eligible perhaps for a 1031 exchange.
Right.
And so if you sell that property and you effectuate a 1031 exchange, then you can defer the gain. It sort of is very similar to the old residence rollover rule, but that's a very narrow application. That's really good to look at for people who have been in their home a long time and they have gains more than $500,000. They really need to talk to their advisor on that.
Right. Now, I was just thinking as we're talking through this example and so forth, of course, the other alternative is basically if they sit tight and somebody passes away.
Yes.
Then possibly you can get a basis adjustment. Now this year, all bets are off as far as exactly how that's going to work. It's a mess
Correct.
because of the temporary repeal of the estate tax. But the general rule as far as how these things work is that you get this fresh start.
Correct.
When somebody passes away, so then you can sell it and not have.
Yeah. So how that would work is that $50,000 purchase price in 1962, if the basis step-up rules get readopted in effect, that means we forget about the $50,000, and then if there's a married couple who own the property in California as community property,
right,
and the property is worth $1.5 million at date of death of one of the spouses, that means the new base on which the gain or loss might be computed is converted to the $1.5 million. So if they sell it for $1.7 million a couple of years later, well, now we've only got a 200 gain and so forth. So
right. Okay. So gee, we've gone through some really good stuff already,
really good stuff.
folks.
Do we have enough time?
Yeah,
we're going to run out of time of things to talk about.
Well, I'm not too worried. All right. Now, so there's a new area of concern. What if the house is used for a non-residential purpose or for a rental?
Well, number one, from the beginning of this new rule, the new rule that was enacted in 1997, let's just go back and analyze that for a
So
minute.
this is when they adopted the new 250,000, 500,000 exclusion.
Correct.
We're talking
And this
about.
was in May of 1997, I believe
Okay.
May 6th.
Okay.
So let's say, for example, that I used part of my home as an office. This gets a little off your thing, but I used part of my home as an office and
right.
residence. And I legitimately claimed depreciation expense from 1997, that May date, through today. And let's say over the years I've claimed $30,000 in depreciation expense. Then I sell the property, and the gain is not only the economic gain. I paid $300, I sell for $500, now I've got this $200 gain. But the gain is also the depreciation that I've taken in past years is $30,000,
Right.
as in my example. So for this special exclusion rule, the Section 121, the home sale exclusion rule, that $200,000 gain is excluded. The $30,000 is not excluded. That's a taxable income related
Right.
to it.
Right.
So that's one of the key rules on this.
Right. And it's also subject to a little bit higher tax rate too.
Correct. It's typically higher, 25% for federal, and of course ordinary for California.
California doesn't